Welcome to the most critical crossroads in Singaporean real estate history. Right now, the GFA harmonization is quietly rewriting the rules of property valuation, effectively shrinking new unit sizes while prices climb. This creates a rare window of opportunity for those holding legacy floor plans. For HDB owners, the equity locked in your 4 or 5 room flat has never been more potent relative to the shrinking supply of spacious private condos. But as global tariff wars loom and geopolitical tensions simmer, the fear of overextending is real. Is this a trap, or is it the final exit ramp toward financial freedom? We are diving deep into the data to reveal why 2026 is the year that separates the strategic winners from the...
Let's address the elephant in the room, the fear market. In 2026, the headlines are dominated by trade disruptions and fluctuating interest rates. Many potential upgraders are paralyzed, wondering if a global recession will tank property values just as they sign their mortgage papers. However, fear is a poor financial advisor. History shows that Singapore's property market has consistently decoupled from global volatility due to its safe haven status and limited land supply. While others wait for a perfect calm that never comes, the savvy investor understands that systemic risks are often already priced into the market. We are examining the top 5 concerns, from inflationary pressures to regional instability, to see if they truly threaten your equity.
The anxiety isn't just global, it's deeply personal. Many buyers worry that the gap between HDB resale prices and new launch condos has become an unbridgeable chasm. They see million-dollar HDBs and wonder if they've hit a ceiling. But here is the secret. The ceiling is actually a springboard. The current market is experiencing a massive liquidity infusion as older generations downsize and pass wealth to the next. This internal capital flow acts as a shock absorber against external shocks. If you are waiting for a crash to enter, you might be waiting for an event that the government's cooling measures have specifically been designed to prevent. The real danger isn't a price drop, it is the erosion of your purchase.
Now, let's look at the data truth that the mainstream media often ignores. Currently, Singapore's income-to-property price buffer is at its widest in modern history. This sounds counterintuitive given the high prices, but when you normalize household income growth against mortgage servicing ratios, the average Singaporean household is actually more resilient than they were a decade ago. We are seeing record-high median savings and a debt-to-equity ratio that would make most developed nations envious. This means that despite the sticker shock, the fundamental ability to service these loans is backed by hard cash and stable employment. The bubble people talk about is missing the most important ingredient, desperation. There is no desperate.
Comparing Singapore to global Tier 1 cities like Hong Kong, London, or New York reveals a startling reality. While those markets have faced extreme corrections, Singapore's institutional control over land supply ensures a managed appreciation. We are not just buying bricks and mortar, we are buying into a sovereign wealth management strategy. The data shows that the current price-to-rent ratios remain sustainable because the rental market is being fueled by a surge in high-value global talent. This isn't speculative froth, it is the physical manifestation of Singapore's role as the central business district of Southeast Asia. When you understand that your property is an asset class backed by national survival, the lending landscape has also evolved. With the total debt servicing ratio and loan-to-value limits acting as guardrails, the risk of a systemic mortgage default is statistically negligible. In 2026, banks are more disciplined than ever, ensuring that those who upgrade are genuinely qualified to do so. This creates a floor for property prices. If everyone who owns a home has been stress-tested at much higher interest rates, then a sudden spike won't trigger the fire sales seen in 2008. This structural stability is your greatest ally. It means that when you upgrade from an HDB to a condo, you are entering a protected ecosystem where the government's interests and your personal wealth goals are perfectly aligned for long-term growth.
But why are some resale units stagnating while others hit record highs? This is the great resale divide. We are seeing a shift where location is no longer the only king. Efficiency and lifestyle have taken the throne. Older, poorly maintained condos with massive sunken costs and maintenance are sitting on the market for months. Meanwhile, well-positioned HDB flats in mature estates are commanding premiums that defy logic. This stagnation is a warning sign. It tells us that the market is becoming more discerning. Buyers are no longer willing to pay for potential that requires a six-figure renovation. They want move-in ready, sustainable, and tech-integrated spaces. Understanding this shift is vital for anyone looking to sell their. We are witnessing a fundamental valuation reset. The GFA harmonization means that developers can no longer include aircon ledges and void spaces in the saleable area. This makes every square foot of a new launch more expensive on paper, which in turn elevates the value of older, larger resale units that were built under the old rules. If you own a spacious resale unit, you are sitting on a space premium that will never be replicated in future projects. This is the data truth behind the record-breaking HDB transactions. The market is finally putting a dollar value on the luxury of space. If your unit has a functional layout, it is becoming a rare commodity.
Psychological anchors are also at play. Many sellers are stuck on yesterday's prices, refusing to acknowledge that the market has moved on. This leads to the stagnation of mid-tier units that don't offer a clear X factor. To win in this market, you must identify what makes a unit future-proof. Is it proximity to a future MRT line? Is it within the 1 kilometer radius of a top primary school? Or is it the unique architectural heritage of the estate? Those who are failing to sell are often those who ignore these microdrivers. In 2026, the broad market trend is irrelevant. The micro market within your specific postal code is everything. You must stop looking at the forest and start examining.
So, what is the 2026 blueprint for success? It starts with a unit selection framework that prioritizes defensive growth. We are moving away from speculative flipping toward long-term bets. The framework focuses on 3 pillars: exit strategy, rental yield support, and the scarcity multiplier. You should be looking for developments where the supply of competing units is naturally limited by geography or zoning. In 2026, the smartest moves are being made in the rest of Central Region, or RCR, where the price gap between HDB and private property is still manageable, but the upside potential is amplified by urban renewal projects. This is where the
Strategic property moves in 2026 require a quant-driven approach. You must calculate your break-even holding period with surgical precision. With the window for the GFA-related swap opportunity closing as more new launches hit the market under the new rules, the timing is paramount. If you move too late, the price gap will have widened to a point where your HDB equity is no longer sufficient to cover the down payment without significant cash outlay. The 2026 blueprint emphasizes the first-mover advantage in revitalizing districts. By identifying areas slated for government-led transformation, like the Greater Southern Waterfront or the Paya Labor Air Base redevelopment, you are essentially piggybacking on billions of dollars in state infrastructure investment to secure.
The window is closing. As we head toward 2027, the structural changes in Singapore's land policy will be fully baked into the prices. The HDB versus condo dilemma is not a question of if, but when. For those who act now, the rewards are not just capital gains, but a legacy of stability in one of the world's most resilient economies. Do not let the noise of the fear market distract you from the data truth. Your home is your most significant asset. Treat it with the strategic rigor it deserves. This is your moment to transition from a passive resident to a proactive wealth builder. Analyze the numbers, trust the blueprint, and make the move that